Okay. We should start. Okay, the first part of the lecture is the prize of FUNCAS to the best dissertation of the last year. That this is a prize for which can compete all students in Spanish university and Spaniards who are studying abroad. This year, we have 130 dissertations. They were super good dissertation, obviously, but the prize was allocated to Isabel Mico Millán for the dissertation called Essays on the Household and Public Finance. And this is just okay, yeah, this is a photo. Okay, this is just. Okay, and the only thing is, if you know a student who is finishing this year the dissertation, as I told you, in Spain or they are Spaniard abroad, please tell them about the prize because it's super easy to submit the dissertation. You have just to send it. And it's great. It's great to have more competition on that. Okay.
So thank you very much, Juanjo, for the prize. So today, welcome to this session. We are very happy to have this guest speaker. So it is my great pleasure to introduce Ricardo Reis from the London School of Economics. So born in Portugal, Ricardo Reis did his undergraduate at LSE and PhD at Harvard. He held positions at Princeton and Columbia, and since 2016 he has been at LSE. So it's one of the cases that comes back and completes the circle.
I didn't get far.
So Ricardo Reis is a macroeconomist who does research in the intersection of financial economics, international economics, and applied econometrics. He had produced not only many, but also very influential papers on inflation and expected inflation. If we did a word cloud with the words in the titles of all the published papers, probably inflation would come the biggest one and the most frequent. Moreover, in his research, consumers and producers are allowed to be less rational and closer to regular, common decision makers who may find too costly to be fully attentive and rational. We are very happy to have you here. Thank you very much for accepting very quickly our invitation and for being here. And today he's going to be talking about the 4 R's, from interest rates to inflation and back. So thank you.
Thank you.
Thank you. Well, thank you very much for having me. I will. When I initially was asked to give this lecture, I thought I have to go and practice my Spanish a little bit, and especially turn my Portuñol into more Spanish. But then I was told no, it had to be in English, and so I'll spare you with my bad accent, my very Gallego accent. I actually speak Spanish, but with a very, very Gallego accent. With that in mind, let me tell you what this paper is about. What's R star? Let me start with a simpler question. Where are interest rates going to? I'm going to use plural interest rates because we know that interest rates on different assets do tend to move together. This is an important question for several reasons. If you are here from the Banco de España, as some are, this is in some ways the key question today, because as inflation looks pretty much under control with the past deviation behind us, the question, and we are lowering interest rates towards their normal level. The big question, I think if there's someone here for the Banco who can back me on this, will tell you is exactly where that normal is the main question being asked in Frankfurt, Madrid, and other places. How many cuts will we have? What is that normal leverage going to be? When will the central bank stop easing? If instead you're coming here from the Minister of Finance or from an international organization that cares about fiscal policy, say the IMF or even the OECD, then you really care about this question because you were, well, interest rates were temporarily high now. They've been persistently very low. Boy, for a very long time, for more than 20 years, we borrowed and borrowed and borrowed, and interest rates got lower and lower and lower. And if you look at the interest payment of the Spanish government as a ratio of GDP, it was completely flat over time. Which is a wonderful time to be a fiscal policymaker because you could keep on running deficits. The more deficits of the debt, the lower the interest rate. So the product of the two was completely constant as a ratio of GDP. Is that going to continue happening, especially since we have a lot of public debt behind us, and as lowering deficits is hard? Or is it not? And being a Minister of Finance is going to become a tough job again. It wasn't all that tough for the last 20 years, no matter what they say. Third, if you're not a policymaker, but instead a macroeconomist, this is a crucial question because if one of the most important models that you learned, for those of you who had to suffer through macro in grad school a short while ago or a long time ago, the neoclassical model, the balance of savings and investments, you may have called it the growth model even if it had no growth, or the Ramsey model, or even the Solow model, is about where do savings and investment meet and what the equilibrium interest rate is. This is as fundamental as it gets, and a lot of other macro questions in growth, business cycles, and others build on what that interest rate is. That is the converging of the interest rate, the steady state interest rate. And finally, if you're an economist who hasn't seen the light and embraced macro yet, but are doing other fields in economics, at some point there's going to be some intertemporal trade-offs in your work. You're going to have to discount futures. And boy, you need to think about what the steady state interest rate is that is going to determine intertemporal trade-offs in your models or that you use to discount in your data. So in some ways, where is interest rate going to? Our star, where we put stars whenever we're talking about long runs, equilibrium, steady states, is a fairly important question in economics. Unsurprisingly, there's been a lot of effort in it. In some ways, maybe too much effort, because we have different ways of trying to measure this R star. Let me tell you 4 of them, as well as their associated difficulties. First, well, if this is a steady state, let me use my toolkit that I learned in my time series econometrics classes to measure this using time series models and ask, which are in some ways estimate dynamic models of time series data, separate trends from cycles, and figure out what the resting point of that dynamic system happens to be. And there's quite a bit of work trying to do this, simpler, more complicated, more sophisticated, or less, using the modern tools, but you can be assured for the econometricians in the audience that if you come up with a better way to estimate long-run steady states, within months there will be some macroeconomists using your technique to try and figure out what R star is in some ways, this being important. At the same time, this is hard. And it is hard in part for the reasons of those of you who were here yesterday at Barbara Rossi's ECB policy lecture, that the data seems stationary or not, so distinguishing stochastic from deterministic trends is hard. There's important trends in these data that are very combined with the cycles. There isn't really a clear separation between these two. There isn't a clear even dichotomy between short run and long run. And insofar as we're talking about the fundamentals of equilibrium of savings and investment, there are so many determinants of savings and investment that it becomes hard to separate short and long run. A second approach, instead, to build models. Instead of using time series data, let me build a model that, again, think of the Solow model or the Ramsey model. That model is going to have a steady state counterfactual. I'll put a little star in it when I draw a phase diagram for you. And then say, look, once I have that model, try to estimate that model, try to figure out the parameters, the slopes of the different curves, and figure out what that counterfactual is, knowing that I'm never at that counterfactual. As for instance, the Solow model, where you never approach the steady state, or you're never at the steady state, you're always approaching it. That, again, is a very valuable approach. In more recent times, usually DSG models to allow for dynamics, uncertainty, series of general equilibrium forces. But of course, there's always somewhat dependent on the model you use, and sadly, when we use these models, you end up with quite a few different answers for something as important as this interest rate. So if the standard errors on answer 1 are high, the model errors on answer B have turned out to be fairly wide as well. A third approach is to look at it from the perspective of inflation and monetary policy. Namely, there is a principle in monetary economics, dating back all the way to Knut Wickfeld's work more than 100 years ago, that if your interest rate set by the central bank is above a neutral rate that's very tightly linked to this R star, it's R star plus the inflation target, then inflation will fall. And if it's below it, inflation will rise. That is using short-run adjustment dynamics to infer whether I'm above or below the long run. Very useful, very smart strategy to go at it. Well, to measure this, let's use expectations of whether inflation is expected to fall or rise. Let's use measures of financial conditions. And this is a work that's both between theory and empirics, that is essentially models of inflation interest rate correlations, or covariances if you want, to try to infer exactly where this is. Again, not easy, and complications in it, and let me leave it at that. A fourth approach is a finance approach. For financial economists, you come to this and say, look, there's lots of investments out there. Let me index them by I. Call the returns R sub I. Well, they're all equal to this R star common return plus premium sub I's. Easy, done. Now, what do I need to do? I need to figure out the I asset whose premium is closest to zero. That will give me the R star asset. Maybe that's a counterfactual in the model, strategy 2. Maybe that's a trend of lots of interest rates, strategy 1. Maybe that is one relative to that are relative to other variables, like an inflation or some other measure. At the same time, a very finance approach is fruitless here, or dangerous actually, because of course if you start saying, no, the one that has a zero premium is the safest, most liquid, most short-term asset that I get for sure, then R star is the policy rate by the central bank, because that's the safest, most liquid, most short-term. But then you just said that where's the policy rate going to end up? Where the best measure of where it's going to end up is where the policy rate is, and you found yourself in a logical tautology going around in a circle. So that's what we've done so far. It's a tough question. I'm going to try in this lecture to, based on some work that I've been doing the last few years, try to come at it in a somewhat fresh way, maybe fruitless way, we'll see, but at least try something. What I will do is add a different approach. It's closer to approach 2 in the sense that I will use theory as guidance. But importantly, I'm going to use theory to define 4 R stars. Not 4 ways to measure one, but 4 R stars. And once I define 4 R stars, I think I'm going to be able to make some sense of why the literature often has ended up, especially when it follows different strategies, with different answers. And when I talk about 4 R stars, I'm going to say that maybe it's been the simplistic emphasis on just 1 R star that has made it so hard to measure it. Because every strategy I use ends up getting a little bit of 1 or 2 or 3 of my 4, and then some of these wide confidence bands and theory bands may just be that we're trying to measure 4 things with different weights, and that's what leads to the problem. So, this talk is 4 R stars, not for attempts to measure R stars, but for actual R stars. To do that, let me introduce to you the 4 R stars. I'll tell you some facts of how they behaved in the last 25 years, pre-pandemic. Then I'll give you the model of how to make sense of them. Then I'll use that model to make sense of the last 4 years. And then the cherry at the end of the cake is use those models to tell you where R star is going to go to, which is after all the question that I set out 10 minutes ago. R star number 1. The one that really, as a macroeconomist, I learned, the marginal product of capital. Solomol, there's no financial assets, all there is one interest rate, the marginal product of capital, the expected return on productive investment. We can measure this, or it's hard to measure the marginal, but the average product of capital we can. Look at total capital payments, divide by the estimate of the capital stock, you get the average payment of capital. If you do that, now, I want to get the real version of that. Actually, even getting the nominal is kind of complicated, or at least I thought it was easy, and 6 months later and 60 pages later, I had a whole paper just on trying to measure this one picture. So it turns out to be a little harder, but I'll save you to those complications that I found along the way. One issue is whether to look at, so first of all, I want the real, so I can measure the nominal as I told you from national income product accounts. I'm going to subtract from this an expected 10-year inflation rate from a survey. That's the green line. And then on the yellow line, instead, I do an alternative where I allow for leverage, where I use corporate bonds to leverage investment capital, because maybe that allows you to boost up the return on the investment capital. Either way, one or the other, the big fact is this is pretty much flat over these 25 years. Okay, here's a trend line over a filter. You can kind of make a big deal out of the fact that it went up a little bit and down a little bit here and there. You look at slightly different measures, the common answer is that it's flat. Now, I'm going to be sure, this is US data for 25 years, but you may say, Ricardo, but what about 150 years, 660? I was in Barbara's talk yesterday, and you really should look at centuries of data. I don't have as much data as she does. I'm not as good as a econometrician as she is. But here's 120 years, and again, instead of fitting a model, I just fit low bandpass filters through it. You know, it certainly moves around, but it's hard to see a big trend in it if you go further back in time for the US or the UK. US till 1920, UK you can go to 1850. And if instead you want to look across the G7 countries, sorry. If you instead you want to look across the G7 countries, or weigh them by GDP in the black line, for all 7 of them, you'd seem to see a fairly no trend in M. I'm going to call this M for the marginal part of capital. Second R star, I'm going to call this Y for yield. And that is the yield, the real yield on a 10-year government bond. Some people call this the safe yield. I'm going to call it the unproductive yield. And to the governments, unproductive. Recent research has measured the return on housing, dwellings. It matches this one pretty closely. Unproductive. Unlike the previous one, which was building the capital stock, private capital stock, as opposed to land values. If you look at this one and you subtract from it either again expected inflation or use actual index bonds that already subtract expected inflation automatically, you end up with a big fact, which is that this, and this again, Barbara talked about this yesterday, for those who are here, this has really fallen over the last 25 years. It's fallen by as much as 3 percentage points. And this is what has allowed governments to borrow and borrow, as I was talking about 20 minutes ago. This matches in some ways the finance models of safe returns, usually, insofar as you use government bonds as that benchmark. This is true, again, in this picture in the US. It's also true as you look across the G7 and even well beyond it. Third one, I'm going to call this rho for holding period returns. Finance guys call it that sometimes. That is not the yield, the expected return, but the realized return. So this is now the change in the price on your 10-year bond, which may come with capital gains or losses, as well as minus actual inflation, as opposed to expected inflation. Okay? If you look at this one, it fell for the first 20 years, but after 2015, it may have actually been increasing a little bit. This is the one that in part captures the side of what R star is that deals with unexpected inflation, and especially the transfers of wealth in the business cycle. And fourth, the policy rate, the interest rate set by a central bank that we think matters for determination of inflation. And here I have simply the federal funds rate minus 2%, so that it's in the same realish units as the other ones. And that, of course, fell 2015 and then rose quite sharply from 2015 to 19. So note how my 4 data concepts, conceptually different objects, mapping into different bits of that 4 measurement strategies, are not the same in the data. And so when you look at the 4 measurement strategies coming up with somewhat different results and big confidence bands, note that in their language they're talking about these 4 things in different ways. And you see this, you read the papers, and sometimes they use actual inflation, sometimes expected inflation, sometimes it's a policy rate, sometimes it's a long-term government bond rate, sometimes it's a housing, sometimes it's productive capital. But these are 4 economic distinct concepts, M, Y, rho, and I, with different trends in these last 25 years and capturing different conceptual understandings of what an interest rate is in an economy. Let me, because I'm going to use them, refer to 4 indicators, and I want to at least have you keep in mind. In the US during this time, there was a big recession, and output was below potential for quite a while, between 2010 and 15. even after the recession ended, help will continue to be below potential. Investment was relatively subdued, depressed, some would say. The term premium, difference between the 10 and 1-year interest rates, was high and then fell with so-called quantitative easing. This was quantitative easing, the whole goal of it. And fourth, the ratio of unproductive to productive capital, government bonds plus housing divided by non-housing capital stock, increased throughout. Keep those 4 things in mind because they're going to play a role in my model as drivers as opposed to things I want to explain. So let me propose to you an extended IS, investment savings framework, to try and make sense of my 4. Why extended? Because usually there's only one R. Although, for instance, the Keynesian IS, the Solow IS, very different animals. First animal. Let me start with the more familiar, the Ramsey, Solow, Ayagari, if you're a little more modern one, where we plot the capital stock on the horizontal axis and the return on capital M, the marginal bar of capital on the vertical axis, potentially a marked up one. Why does it slope down? Because the higher is the capital stock, the lower the marginal part of capital because of diminishing returns, marginal returns to capital. The standard neoclassical production function is what we use here. When does this shift to the left or down? That is, when is it that you have a lower return for a fixed amount of the capital stock? If TFP is lower, population is lower, the price of capital goods is lower, pretty important, depreciation increased. Depreciation increased quite a bit with the move to intangibles, or if public investment is just lower in itself. Okay? This should be the easy one. It's going to get a little harder now. But it's okay. You have croquetas at the end as a reward. Okay? Number 2, savings. In the growth Ramsey model, this is a horizontal line at the discount rate of the agent. In most modern models, it's an upward sloping line because of incomplete markets or borrowing constraints, meaning that the more capital I have, the more satiated I am in terms of being able to have the safety and liquidity, the safety they give me, and therefore the higher the return they have to pay me for me to hold them. Okay? This shifts if there's fewer savings in total because of demography, inequality, TFP changes, but also if there's competition, regulation, taxes, affecting essentially the attractiveness of savings. Beyond those incomplete markets models, though, I'm going to speak a little bit more about that savings curve. But for now, let me just say that point A is the equilibrium M and K that potentially would be familiar to you from a standard neoclassical model of equilibrium investment and savings, which for now doesn't seem all too unfamiliar, at least once you relax the complete markets of the Ramsey model and allow for an upward sloping savings curve. But I'm going to go beyond that. I'm going to think about a world in which instead of there being one capital to invest in, there are 2, productive and unproductive. The productive one has this return M, but the unproductive has a return Y. Now, agents are going to have to be indifferent between these 2 in some equilibrium sense. The more the productive capital gives me a return, the higher must be the return on the unproductive capital. There's going to be an upward sloping portfolio arbitrage, if you want, relation between the 2. It's not the 45-degree line. They don't have to be the same. Why? Because the unproductive capital may give you what the literature has in the last 15 years been busy calling convenience yields associated with the safety and liquidity of government bonds. This will shift right or down when the productive investments are perceived as riskier or less liquid. So they better pay you more M for the same Y. Let me talk about the second fact soon when I get to it. What's the other equilibrium here? The other relation here is the classic, you may call it the Euler equation. I guess you should call it the Ramsey equation because Frank Ramsey first derived it in the 1920s. The result that, the famous Ramsey formula, that the growth rate of an economy is equal to the difference between the total return on savings minus the discount rate. You can add in centralized substitution if you want, but I'm a log preferences guy. Okay? G equals R minus rho. I shouldn't have said rho. Never mind. G minus time preference rate, because rho means something else. Okay? You invert that, it says that the total return in an economy, as again Ramsey first did in 1927, the total return in the economy is going to be equal to the discount rate plus the growth, the return in the economy is going to be the discount rate plus the growth in the economy. And that is, again, one of the strategies to measure this. But now, if the total return in the economy is a weighted average of productive and non-productive investment for a fixed growth rate of the economy, discounted growth rate, there's going to be a negative relation here. Because for a fixed growth rate, more investment in more returns on one of the assets is going to mean, for a fixed growth rate, that the other asset must be giving me a low return. Or alternatively, if you don't want to fix the growth rate, that if you have higher return on either productive or unproductive, then I'm going to save more and have higher growth rate of consumption. And that leads to a negative relation here, which I'm going to call the Ramsey-Euler equation, affected by changes in the growth rate or changes in the relative weight of the two assets, say due to financial frictions. So the savings curve that I put for you earlier can be seen as a result of this intersection. Namely, the portfolio arbitrage, the Ramsey-Euler equation, are going to give you an equilibrium M and Y, but if I have more investment in productive assets, kappa increases. Well, that means that for me to want to invest more in kappa, it must be that the return M has to be higher. If you want, the portfolio arbitrage equation has to shift to the right. And it's that shift to the right that maps into the upward sloping relation on the right-hand slide. So that's the derivation of the savings curve. Third, realized returns, rho. The economy, given its capital stock, can use variable inputs to achieve a potential amount of output. A vertical line there, I'm going to call output X, because I already was Y for yields. So XP is potential output. However, there are also variable inputs of production, labor being the most famous one, but not only. People contract those variable inputs, the suppliers of those, keeping in mind expecting a certain return, having a norm for what the return that they want to get. If it turns out and they will contract and agree to supply a certain amount of labor and the variable inputs with that norm for a return. If it turns out that the ex-post return is lower, then the firm will hire more overhead labor. If the return is lower, the firm will see a bargain, if it is higher, the firm will say, I want to hire fewer hours from you. This is the Milton Friedman story for misperceptions of a Phillips curve, if you want. For those of you who remember that, I don't think we teach that anymore, but the older audience will remember that. Okay? And it says that if inflation is high, realized returns rho are low, below expected returns. Remember, Y is the expected value of rho, and therefore output is a potential. But when inflation is low, realized returns are high, I agree to pay a very high wage to my workers, I now hire fewer workers, and output is below potential in the medium run. So this is what's sometimes called an agate supply or AS curve. On the other hand, when does this shift? If productivity falls or markups rise, potential shifts to the left. But at the same time, if there's a higher norm for the remuneration of the variable factors, this will also potentially shift to the left. And likewise, especially when capital K is lower, this will shift to the left. Next equation, policy target. Monetary and fiscal policy tries to trade off unexpected inflation against output deviating from its target. Key result, if you try to trade off the two, such the AS that I showed you, is that you're going to have an economy in which you're going to sometimes tolerate output that is higher if inflation is lower, sometimes output that is lower if inflation is higher. Or in terms of rho, which is minus pi, you get an upward sloping relation between the cost of inflation versus the cost of employment. This is the optimal targeting rule, if you want, how policy that has to deal with expected versus unexpected will have to behave. When does it shift right or down? When we underestimate potential, when we overestimate the inflation norm. The 1970s is the classic example of when this equation was introduced. What is the goal of policy then? Fiscal and monetary policy, as aggregate demand management, is about shifting the PT curve, which policy controls, to hit the economy at the kink, where we have inflation on target and output of potential. Have too tight aggregate demand, and the PT curve is to the left. You have low inflation, but also underuse of resources. Stimulate the economy too much, and the PT shifts to the right, and you end up with persistent high inflation. Finally, short-run monetary economics. A Phillips curve combined with an IS curve sometimes, but really it's a Phillips curve, says that there's a negative relation between inflation and the policy rate. Why? Because if you lower the policy rate, you temporarily stimulate demand that pushes inflation above the expected value by the price-setting firms. Oops. Okay? The shift when expected inflation changes, but also when term premium changes relative to the Vixelian rate, because the Vixelian rate of the Y before has to be adjusted by a term premium to translate into this short-term interest rate. And then on the other side is a Taylor rule. The higher is inflation, the higher rise interest rates, subject to, though, the fact that I have a zero lower bound that I can't lower the policy rate below some level. And this shifts whenever I target higher inflation, this shifts to the right. The equilibrium is at a point A, where inflation is on target, and the policy rate is just equal to the yield divided by the term premium, the difference between the short-term policy rate and the long-run yield Y. And policy is all about trying to shift the Taylor rule to intersect the PCIS at just the right point when expected inflation equals actual inflation that equals the target for inflation. And so those of you who work for a central bank, you're the guys shifting the blue curve, trying to hit point A. So, for our stars, for productive capital, unproductive returns, realized returns, and finally policy rates with inflation. And what I've done so far is introduce to you a graphical apparatus of certainly a general clear interpretation where structural determinants, perceptions, and policy goals lead to a combination of these 4 R stars being realized in equilibrium. Yeah? Everyone's happy? You learned a model. I'm happy. I don't know. A model that can make sense of it in a graphical way that hopefully was understandable just through shifts. Let me use this. Okay, fine. It's a model of 4 R stars. As of now, I'll claim success if you understood that these 4 R stars are different concepts, empirically they behave differently, and the models say they should be different. I work through the standard investment savings, the standard portfolio when you have 2 types of capital, portfolio choices, the standard how is it that realized returns differing from expected returns leads to underuse of resources, and the standard how policy rates lead to higher or lower inflation. And across all 4, I did not end up with a conclusion that M is equal to Y, that's equal to rho, that's equal to I. M will be different from Y because I like unproductive stuff. They give me safety, they give me liquidity, for instance. Y will be different from rho. Why? Because sometimes actual inflation is different from the inflation norm that we contracted upon. I will be different from Y because inflation may be different from the target, and on top of it, there is a term premium between them. Now, next, let me see if this is a useful framework. I think it was useful to do concept, but let me see if it's useful now to contrast it with the data. What happened in these 25 years between 95 and 2020? First, as many have documented, and Lucas Rachel at UCL especially has really documented and summarized very effectively, we had, for 25 years, a fall in the relative price of capital. Capital goods have become cheaper relative to consumption goods. We had an economy that grew at a slightly lower rate and population at a significantly lower rate. We've had a decline in public investment following austerity post the sovereign debt crisis. I would add to these factors in Lucas's very important work the fact that depreciation got higher as we move from tangible to intangible productive capital, and then markups, as in the work of Jan Eckhout and Jan de Locker and many others, markups seem to have been somewhat higher during this period. Combine all of these, and this is a shift down of the investment curve. That leads to less investment, as we saw in the data, but should also come with lower M. The literature has been content to say, well, M is Y, and therefore I've explained why Y fell. But M didn't fall. What we need is that the savings curve have to have shifted to the left, because M didn't change that much. That's consistent with the fact that investment actually was significantly depressed. But why will the S-curve shift to the left? We need to go to our second plot, which was exactly the one that determined the shifts in the S-curve. Let's go back to fundamentals as we think back at our Ramsey-Euler portfolio balance equation. Let's go back to the same fundamentals used to shift the investment curve. Demographics and aging have meant that we want to save more. Wanting to save more shifts the Ramsey-Euler equation to the left. Productivity and population growth, again, their declines mean an increase in desirability of saving. They shift the Ramsey-Euler equation to the left. Inequality means that insofar as the rich are richer and they have higher propensities to save, this has been worked by Atif Mian and Amir Sofi and Ludwig Straub and others, would imply the Ramsey-Euler equation shifts to the left as well. And finally, literature has mentioned that, well, with global imbalances, meaning Southeast Asia saving a lot, as a man pushed for, the Ben Bernanke associated with this idea, a big increase in savings, and a big increase in savings again is a shift the Ramsey-Euler equation to the left. Why to the left? All of these are reasons why you want to save more, therefore you're willing to tolerate less returns to save more. And remember, the returns are there, more savings shift is towards the origin. But if that was the whole story, M would have fallen as much or more than Y. What must have happened to fit the data is that the portfolio balance equation shifted to the right. Can we make sense of that? Because that shift would lead to a shift in the savings curve to match the facts, would lead to an MY gap that matches the facts as well. Why? What shifts the PB curve? And now let's go back to the shifts the PB curve. I know you weren't paying attention 20 minutes ago, but now I can go over them in a more concrete way. First, let's think back about the global imbalance. Remember, the portfolio balance is your relative desire for productive versus unproductive capital. Has there been some the last 24 years that shifted the desire of investors for one and the other? Well, I have 4 things that justify that shift, documented in literatures outside of this particular application. First, think about the global imbalances. Global imbalances came with, again, let's call it China, saving a lot abroad. China running a current account surplus, which comes with capital flowing abroad and pushing up the savings on the Ramsey-Euler equation. But remember that the savings of China as a country are not the savings of the savings choices of households, but they're the saving choices of a state government that controls capital control, that has capital controls and directs some of those savings abroad. And what does that government have? It has an enormous taste for liquid savings that it can use to precisely control capital and even interfere in the exchange rate, and moreover faces an enormous information asymmetry in investing abroad. Why? Because the Chinese arrives in Spain, says, I want to save in Spain. Immediately a Spanish guy says, why don't you buy this, my company, it's a wonderful company, it's very productive. Chinese doesn't understand anything about what this company is. So he has the information asymmetries that lead to productive capital. The Lemons problems that makes productive capital have to pay a higher return are especially higher once the saver, the investor, is not a national, but rather a foreign from far away, and especially a state-controlled foreign. So with the global imbalance comes an increase in the desire for liquidity and savings. And with that comes a shift of the portfolio balance favoring the unproductive to the productive assets. Second, we had a financial crisis during this period. And that financial crisis came with both an increase in risk aversion of individual investors, as well as an increase in regulation forced them to do that. And regulation, between 2008 and 2012, all regulation went in the same direction. You must hold a government bond, an unproductive investment, as opposed to a productive investment, because that will be safe or liquid. So regulation pushed very strongly for a shift to the portfolio balance equation. At the same time, there was an increase in supply. Remember, governments were issuing more and more and more of these unproductive assets. And finally, note that insofar as the economy became more one that geared towards chasing markups and chasing the rents associated with them, again, unproductive chasing of those rents became a destination for a lot of the financing, as we see in the trends observed in what the use of financial instruments went for. A decline in fiscal investment and more use of leverage in order to buy and sell assets across the market. So combining all of those, we do have good reasons that quantitatively work for why this shifted, for why we explain our Y prime together with our unchanged M, why we have depressed investment together with unchanged M. Let's continue. What about rho? As we had that shift and we had the depressed investment, that shifts the AS curve to the left because potential output gets lower. We have less capital stock, remember? All those problems on the investment that I was talking earlier. Moreover, we had the higher markups and the higher depreciation rate, which themselves also lower the potential level of output. What that means is that as Y fell from Y to Y prime from previous slide, unchanged policy would lead to underemployment. Somewhat matching what we saw in 2010 and 15. Post the crisis, as this AES shift to the left, unchanged policy leads to somewhat depressed economies, as we certainly experienced here in the Iberian Peninsula. As policy faced the challenge between 2010 and 2019 of stimulating aggregate demand, there was a saying in 2011-20, every policymaker all of a sudden was a demand-side Keynesian. It was all about stimulating demand. You know, the ECB, all they talk about is stimulating demand, stimulating demand, stimulating demand, all about shifting the PT curve to the right, so we'd go from B to B double prime eventually. Fiscal policy, deficits, deficits, deficits. ZLB economics, for those of you in macro. Monetary policy, let's go to zero, let's go to negative interest rates. By the way, some of this also happens naturally. Why? Expected inflation starts falling, people start being happy with no wage increases, the norm falls as inflation is successively below target, realized returns a little bit higher because expected inflation keeps on coming below and below. We keep on talking about the Japanification of Europe. That wasn't even a word. We're becoming Japan, inflation is being stuck very low. People start telling stories about how it's the loss in union power, is the Chinese, I can't raise your wage because I have the Chinese competitive margin. All of this is consistent exactly with a shift of the PT curve as those norms change. And finally, monetary policy. Well, the shift, the lower Y, meant that the Phillips curve shifted left. We found ourselves intersecting at this point B, when inflation was below target. And what did, and this is partly again why the PT curve was to the left, and what did central banks do? They engaged in quantitative easing to lower the term premium from T to T prime, and in doing so, be able to shift the PC back to point A and achieve back a stable inflation at the new kink point of the PT curve that you saw before. And so what was policy in 2015-19 was all about lowering T prime in order to escape the ZLB, in order to shift the PT curve, in order to achieve the kink. So I will claim, and since you can't interrupt me, I can claim it unopposed, that this framework works pretty well over the last 25 years, not only conceptually in making sense of the difference between the four returns, but also in terms of fitting the trends of the last 25 years. So now I can get to the dessert and spend the last 10 minutes on the future. I have a framework, it says I have 4R stars, it makes sense of why measurement had trouble with them, it makes sense of the data of the last 25 years. To be clear, I'm not being overambitious. The trends in the data, up, down, not like why it went up and down in every one given year. I'm pretty far from that. Why the policy was done, what policy we observed, and so far, I have a framework that, as usual, in standard macro work or economic work, you figure out a concept, you figure out a model to make sense of the concept, you make sure it fits the past, and then use it as a lab to do counterfactuals, in this case, about the future. So let me talk about the future. First, let's talk about the recent past. And then, being a lousy econometrician, I'm going to extrapolate from the recent past and say, what if the recent past persists? What's happened to the 4R stars after the pandemic? M continues to be incredibly constant, maybe felt a little bit, even as investment has picked up. In the last few years, investment has been very high. Public investment and private investment has been, especially in the US, significantly high. Y, which had been falling and falling for either 25 years or if you went to Barbara's talk yesterday, it's, I don't know, 500 years, I forget how many she had, has been going up. And it's been going up a lot. It's back to where it was in 95 or earlier. That's the red line. What about rho, the blue line? I don't know. If you held bonds, you would know. I guess you don't know. Otherwise, some of you would be crying out of trigger warning from seeing the blue line. If you held bonds, you lost 40% in the last 2.5 years because we inflated the heck out of you. It wasn't good to hold bonds. Hope you shifted to equity soon enough. Should have paid attention to those of us saying inflation was coming. Otherwise, it was a bad, bad time. Very negative returns because of the unexpected inflation. And policy, in red, was really low for quite a while and then really sharply rose. That's the one that gets the attention, for those of you paying less attention, and has stayed high and now is starting to fall as central banks are starting to talk about cutting. So that's what's happened to M, Y, rho, and I. Again, not the same thing, different trends. R star is not the same thing, okay? So, let me take as given two things here, but I won't take them as given just from pure extrapolation. I'll take them as given because I think there's some arguments why they may persist. And that is that M stayed roughly constant, maybe fell a little bit, and Y has really sharply risen. Can I make sense of that in a way that persists? Because I want to put stars. These aren't stars. 3 years is not enough for a star. You know, it's supposed to be steady states. You need more years. Why? Look, how can I make sense of an M that falls maybe a little bit, but a Y that increases a lot, from Y prime now to Y double prime? Remember, we started in this B point? How do I get to a C point? Well, I can have a shift right up of the RE curve, but more importantly, what happened to the portfolio arbitrage, since that's the one that paid more attention? Why would it have shifted back to what it was, somewhat back to the trends of the last 25 years? In other words, going back to these 4 stories, did they revert in the last 4 years? And the answer is, they did in part. In the future, first, starting with the safety perception of government bonds, that they were very safe following the financial crisis. Again, if you lived through the last 3 years and you had your money in bonds, you had a rude awakening. They are not that safe when the government inflates you away. So everyone who got scared about equities in 2009 now should be very scared of bonds. All of a sudden, equities and productive investment look really great. Bonds look dreadful. So if there were scars from the financial crisis, there are now scars from the inflation crisis that revert the portfolio balance in the other direction. Second, global imbalances. Not only is China no longer running the current account deficit that it was, but also there is a clear shift in the data already that likely will persist, where they are no longer so happy and perceived as a safe and liquid to buy US Treasuries. Because for conflict, call it geopolitics, call it simply the Americans saying, I'm not going to pay you back because I don't like you anymore, because if you were a naughty boy and invaded someplace you shouldn't have. The Chinese are divesting from treasuries in the last 2 years, finding any other asset they can, in other words, showing the opposite of a preference for US Treasuries that drove them before. In flows, they're even reverting their stocks, but note that here what goes in this equation are the flows, not the stocks. And third, more generally on the riskiness, the elections that we have had and the perception that inflating away the debt is something governments will find appealing also works against the perception of safety and liquidity of unproductive investment versus productive investment. All combining to shift in the portfolio arbitrage curve and delivering the Y and the M that we observe. Or alternatively, that the savings curve is shifted right, that we're seeing investment booming as we have in the last 3 years with only a slightly lower M precisely because of the shift in savings. You can also combine this, by the way, with an increase in investment, that probably a shift in the investment curve, having to do with both the increase in public investment and optimism about AI. That's certainly important in the US, and that again reinforces why M has fallen very little. These are small for now, but looking ahead, because I want to talk about stars, A world in which y is forever higher now, and m is roughly constant, is consistent with both the last 3 years of data, but also all the determinants I talk about in these 2 slides are probably things that are not going to change in the next few years, and so this seems like potentially a star outcome. So, what's the new R star? You can go home and say, Ricardo thinks that M star, the same, it was the same 5 years ago, it was the same 10 years ago, it was the same 30 years ago. But Y, that has fallen so much, has now increased in the last 4 years, and maybe is going to stay forever higher at that higher level if I'm right about these past trends persisting. But now what about, and this is where the part of the title comes, what about rho and I? And remember, rho and I had to do with interest rates and inflation and back. Namely, what about policy? Oh, first, sorry. Let's talk about policy. Yes, let's still talk about the past, and I'll get the last 2 years. What happened in the last few years? The persistently higher Y meant that the AS shifted up from dark blue to light blue. What did we have? Policy that embraced high inflation. With that shift, we kept interest rates too low relative to their natural rate. We had high inflation that avoided underemployment. We were afraid of the pandemic recession. My model can fit that relatively well. We liked inflating the pandemic debt. Remarkable fact. The US spending on stimulus in 2020 and 2021, more than 90% of it has been paid by inflating with the bondholders. Quite incredible. Okay? By staying at B instead of shifting all the way to C. So the PT stayed in the same place for a while. We screwed the bondholders through low realized returns. The return stayed at Y prime instead of going up to Y double prime. This also meant by that the higher Y meant that the PCIS shifted to the right. Again, by keeping interest rates low, we let inflation jump up to the high level. We should have raised interest rates more than we did. But what about the future and the policy trade-offs? Now, let me give you 3 scenarios when it comes to policy. First, maybe policymakers realize on the monetary side that the new neutral level of interest rate is higher. We're not going to go back to 0% ECB policy rates. They're going to stay forever higher at, 2% maybe? Around there, maybe 2.5%. That means the PT curve shifts back to the kink. Rho matches Y double prime, a higher long-run level of government bonds. Add to the 2.5%, another 1.5% of term premium, 4% interest rates for Spanish debt going forward, 4, 3.5, 2, 2.5 rate set by the ECB. The economy is at potential. We deliver 2% inflation rate, which, like I said, requires now a lower policy rate. That is a benevolent scenario where the policymakers catch on. They realize we live in this world with a higher Y prime. We continue to deliver on potential. The ECB continues to deliver a very successful stable inflation and output near to potential, even if that potential is a little disappointing for us, just as it did between 1999 and 2019. But let me give you a second scenario, a high inflation scenario. Imagine the next few years, policies afraid of shifting the PT to the left for fears of underemployment. You can associate this, for instance, with mistaking what is maybe lower structural growth for lower transitory growth, meaning seeing an increase in unemployment not as a reflection of the bad terms of trade shock we've suffered with energy prices, but rather as a temporary recession that we need to be stimulated away from. And on top of it, beyond a policy mistake of missing natural rates as in the 70s, we have fiscal policy saying, think about the elections in France, think about Italy's politics, saying, hey, this low realized returns was really nice. It's a great way for me to not have to balance my deficits. That says that we start saying maybe keeping the PT curve here to the right and the D prime point is not so bad. As norms adjust, we know that we would then spend the next few years, much like in the late 70s, between D and D prime. In an economy that is at potential, even if that potential is disappointing, but where inflation keeps on being higher and higher as we try to inflate away the bondholders, avoid a recession, much as in the stories we tell of the 1970s. That is a story in which the central bank is essentially shifting the Taylor rule to the right and going from the D to a D prime, and then as expectations adjust to a D double prime. In other words, this is a modern version of the conventional story of the 1970s, starting with Friedman, more recently by Sargent, Primiceri, and others. Okay? That we end up in a world in which the natural rate increased. And it's wonderful to go and read Milton Friedman's presidential address back in the late 60s. It doesn't talk about the natural rate of unemployment. It talks about getting wrong what, in my language, is why. That exactly the central bank misses out on why. Because of that, keeps on targeting a much too low value here. And as a result, we end up with ever-increasing inflation for a while. The combination of mistakes as well as temptation, because with all the debt problems, it would be nice to inflate it away just a little bit more. After all, the last 3 years were great. Ministers of Finance didn't suffer that much in the last 3 years. Not that many tough choices. The next few years, there will be very tough choices. Okay? When you combine honest mistakes with it would be nice to make those mistakes, and let me add a third ingredient to the mix, authoritarian populist politicians who will pressure you to make mistakes, you end up with a recipe for high inflation going forward. That's one scenario. But being a macroeconomist, I never give you, well, being an economist, I never give you a proper forecast. I say on the one hand and on the other hand. So let me give you another scenario. I give you one scenario, inflation 2%. I give you one inflation is persistently higher. Let me now give you a scenario where inflation is forever lower. And that is this scenario. Imagine term premium rise. Why? As we understand the temptation to inflate the debt, we, the bondholders, get ahead of it, the savers, and start requiring higher and higher inflation risk premium. I need higher interest rates paid on the 10-year debt. Remember that short-term rates, policy rates, don't have an inflation risk premium. They're overnight. So you end up with a higher term premium, T double prime. Moreover, we anticipate financial repressions coming, because if it's not inflation, boy, the government's going to end up taxing me, the bondholder, because they can't sustain this debt. If that is the case, the increase in the double prime, what it does is we end up with the PCIS shifting left, and we end up back at the zero lower bound. We end up back at policy rates being too low and aggregate demand too depressed. QE has been exhausted as a tool because we overused it in the last 10 years. But not only is monetary policy finding itself in the ZLB trap, but also fiscal policy is unable to move the PT curve back to A, but stuck at C, because now this comes with the high Y, meaning there's no fiscal capacity. We have high long-term interest rates constraining the fiscal authority, can no longer try to stimulate the economy. A fiscal trap, together with a monetary trap, because the increase in the financial repression term premium has now meant that policy rates are also too low, hitting zero lower bounds, and unable to stimulate the economy. So we end up with a double trap, where we end up with output below potential, back to, if you want, ZLB economics, with output below potential and inflation too low and actually returns in the bondholders not so bad. Let me conclude. I think I'm just on time. I'm 2 minutes over. Not too bad. Let me conclude. I tried in this talk to answer a very big question in all of economics. Where is our star going? Okay? It's hard. It is very hard. Forecasting it is extremely hard. We're talking about a counterfactual, something you don't observe, long-run value, something you'll never get to observe, concept that affects both inflation and investment savings, as well as all the premium in the economy. It's hard. At the same time, the reason why it's hard is also why it's so important. It is central to most of our micro debates, macro debates, discounting futures, understanding inflation, and others. You cannot ignore this hard question. Okay? How to make progress? In this talk, I try to make sense of why the attempts at measuring our star have had so much trouble by saying, oh, we've had trouble chasing the rabbit because there were 4 rabbits running in different directions. That's why we kept on shooting and not hitting the rabbit. Let's instead try to measure each rabbit, recognize there's 4 of them, have a framework that makes sense of all 4 of them, have therefore 4 pistols to chase the rabbits. Sorry for those not hunters. Sorry, I'm not a hunter either. Anyway, I see cartoons, so anyway, I have young children. Have 4 different guns, 4 different diagrams to chase the 4 rabbits, and then understand the policy constraints that we have in shooting our different guns and making sense of them. That attempt at looking at 4 rabbits was, at least to me, enlightening of the trends of the last 4 years, was enlightening in understanding why the literature had struggled so much, was enlightening in highlighting how different shocks, different forces, all played a role in driving this difference between R stars in different ways. I then looked at the last few years and said, in the last few years, Y has increased a lot and M has not. I noted that my attempts at making sense of the last 3 years all suggested this is a persistent state of the world, not a temporary one. And then I conjectured. I conjectured of what would a world with a much higher Y and an M constant, productive return on capital is flat, but a much higher return on unproductive savings lead to in terms of policy challenges. And the policy challenges are to be able to get the first scenario, but not the other 2. To be able to get output of potential in inflation 2%, knowing that there's a risk that we have persistently high inflation with low and then high policy rates, policy rates that are kept too low for too long, lead to an equilibrium with high inflation, and then we end up just with the rates end up being higher. That is that we try to expropriate bondholders at first to then just end up having to compensate them for the risk premium, and therefore in a 1970s type scenario. But also another scenario where the increased term premium leads to a double trap, Keynes back with a revengeance, if you want, liquidity trap, stagnation in the sense of aggregate demand being insufficiently accommodative. Which of these is more likely? I'd like to say the first one, and I think that's certainly my mode forecast. But perhaps more usefully is that I think the risks to inflation, in a persistent sense, are now two-sided, up and down, with some probabilities that I can't quite assess right now, but hopefully I've given you the tools to make sense of them and to use the data to think about which one it is. Thank you very much. I think we take some questions now, right? So I think the microphone is over there or over there, so put your hand up. The croquetas are almost here, but you can still ask a couple of questions before that.
Professor Reis, many thanks. Very exciting, and it makes me think. I'm left wondering, however, I mean, the whole theoretical apparatus looks like closed economy, right? But then we use global imbalances at will, right? And I'm wondering, I mean, the US is running a current account deficit of, I don't know, 5-8% a year for a couple of decades, maybe or more. I'm sure that cannot be the steady state. So I don't know if, you can hint me a little bit how to go about this, and then I'm going to take the opportunity I have you here to ask. So more in general, so how do we do now? I mean, I understand theoretically how we like to separate the cycle, the trend, and then think about the policies that go with one and the other. But I mean, so we are going green, we are going digital. You see, we are changing tens of things of our economies now. I don't know, Europe has invested 600 billion in changing everything around. What is potential output? Where is potential output? Where is potential output gonna be? And then how helpful, I mean, thinking along those terms can be when we are so lost, or I think we are so lost about what is the potential or what it will be. Thank you.
Good. So let me answer that question. So you are very right in that this was the equilibrium in one economy with its savings, both productive and unproductive, with its return, with its inflation monetary policy, as well as other aggregate demand policies behind this PT curve, this policy targets curve. So it was a closed economy. And at the same time, it was a closed economy where global imbalances and other prices were shifting it. In other words, I should have had, if you want, another 4 graphs for the other economy. Okay? The links between them I explained, In fact, joining this graph here with the same graph for the other economy is what's sometimes called in international macro the Meltzer diagram. So this investment and the Ramsey diagram, we can combine it with a Meltzer diagram for the other ones, and we can talk about the two together. You'll have to trust me when I say that my story is consistent with having the other diagrams. I made it consistent because shifts in the other economies in its desire for safety and liquidity and investment capacity shift precisely the curves the way I told you, the Ramsey-Euler and the portfolio balance equation. They will have shifted in that way. So I did do the open economy analysis. I just didn't show you the other side. In other words, I didn't solve for the equilibrium returns or inflation in China, which played a fairly big role in my story. So that's number one. Number two, you asked two questions, I'm going to give you three answers. So I can't count very well. Okay. Or you know, I like to multiply. 1 R* 4. 2 questions, 3 answers. Okay. Second, on things changing in this context. I think there's a very important change coming, which I think is going to be very exciting for me as a researcher, not so exciting for the couple of policymakers there. We have a US economy that, and I'm going to use essentially the concepts that are here, so I want to stay in those. Since you talk about changes, I'm going to changes here. We have a US economy that shows all signs of consumers loving to consume, not wanting to save, while at the same time investment booming. That means that economy is going to run a current account deficit, because that's accounting. We have a Chinese economy where, we can't talk so much about consumers as much as the government choices because of capital controls, where they love to save way more than they love aggregate demand. So they're going to run a current account surplus. Okay. Now, at the same time, Trump and responses are trying to make the current account between the bilateral trade balance between those two countries be essentially balanced. Macro meets micro. It can't be, unless there's a third economy. Let me call the third economy Europe, or more accurately, the center of Europe, Spain. You're in Spain, center of Europe, okay? There has to be a deficit in the US. There has to be a surplus in China. They're trying to get the bilateral balanced. How does this clear? We run a surplus with the Americans, and we run a deficit with the Chinese. What does that mean for changes in Europe? This is just the equilibrium forces coming. How would that come about, by the way? A depreciation of the dollar, a depreciation of the renminbi, and appreciation of the dollar, which is already happening with the tariffs in the last 6 months. This is a world in which we import a bunch of cheap Chinese electric cars, we decarbonize, yay, not such good news for SAEe, sorry. But on the other hand, great news for all the stuff we can sell the Americans all of a sudden. I don't know, Balenciaga bags or something. Is that even Spanish? I don't know, maybe it's French. I don't know. French on most of it. We can sell a lot of stuff to the Americans that we're not selling now. That may be, in this context, note that the Y and I that I was talking about here, this is an analysis that was very US focused, apologies, even though I was doing it in Spain. That implies very interesting things, and I'll just leave it at that because it would take me 20 minutes to use my framework to see what does that mean for Y, M, I, and rho for Europe. But that is a brave new world that I hope in Europe we're embracing. I get very worried when I hear people in the center of Europe, in Spain, talk about how we want to put tariffs on the Chinese cars without understanding that that means also not exporting to the Americans and how they want to balance this out. Again, within the context of this, no, savings has to meet investment, ultimate equilibrium. Third answer, then you ask, but what's potential output? Absolutely. In central banking, in the last 40 years, it has proven to be more useful, especially after the bad experience of the 70s, to try to track R star, or in my language, I, as opposed to potential output. That is, instead of trying to hit for the kink, hit for the horizontal axis. And that's led to the growth of Taylor rules, interest rates being used to target inflation. Trying to keep track of Y is better than trying to keep track of XP. That has worked very well for 20 to 30 years. That is precisely what motivates the beginning of this talk, going back to slide 1, which is literally the first bullet point, which is trying to figure out what I try to answer here, figure out what the Y prime or double prime and the other ones are, will be a way to make sure that even if I know what potential is, at least I'll keep inflation under control from the monetary perspective. At least I'll make fiscal choices that are consistent with avoiding a sovereign debt crisis. more question? No, I can't see very well with the lights, but there's one more there.
Thank you, Ricardo. A great presentation. Let me vote for the pessimistic scenario in Europe. And let me stress that there is a structural change which is very much behind all this, which is demographics. And you have a world in which Europe is aging very, very rapidly. China and the US also, but Europe is going to be ahead. Maybe not of China, but of course ahead of the US in aging. This has implications for capital flows, international capital flows. This means that we are going to have a lot of savings. We will have to put those savings in, probably in the US. And this implies that our R-star, if you can define R-star in an international economic, which is not clear that you can have area-specific R-star in international economics, but that means that our star is going to be very, very low, and that means low growth and secular stagnation. In fact, your approach number 2 is the way I display my students secular stagnation. We're in a world in which, like that. So, you mentioned demographics, but to my taste, you didn't stress that much the demographic change, which is going to be huge. So I wonder if you have some more thoughts on this.
Not huge thoughts. Everything you said I agree with, and it's consistent with you're right that it emphasized less the demographics. I mean, they were there in terms of explaining the trends, and they fit the story perfectly well within the framework. Because demographics didn't change in the last 3 years, I just didn't emphasize them then. Maybe they will change, but as you said, demographics are too slow moving to change, and they're a force towards precisely what you said, what I call the C equilibrium, the stagnation equilibrium, and that scenario of the double trap. So they were part, nothing of what I said disagrees in any ways with what you said. So I have nothing really to add. But I still have your attention, and I have 30 seconds, so I'll try to say some things that are useful on the demographics. I think the real question ends up being on why is it that you save and I save? Do we save for retirement? Do we save for bequests? Do we save for precautionary reasons in some ways? To talk about the 3 classic channels. I think those are the 3 classic. Maybe there's another one, but those are the 3 that come to my mind right now that I think I teach my students. Because the behavior of savings, and what do you think we'll do? Again, I'm going for demographics. Demographics has many implications, but I want to talk about savings because that's all I've done here. Differs in interesting ways as you think about those. Yes, I know I will live more years, and so I want to save more. Conditional on my retirement age not rising. But work is becoming less and less physically intensive. Social security programs are getting more and more stressed. We raised the retirement age by 5 years. Sorry, Spanish people, I know this is you don't like it. French people are melting right now. But we raised the retirement age by 5 years, and all of a sudden, you don't get any excess savings actually from the demographic changes. All the increase in life expectancy can be solved from a life cycle effect by raising retirement age for 5 years. And I see a lot of people who want to work a little longer, maybe because I'm surrounded by workaholics. Again, some other people seem to protest on the street. But what certainly sees the ability to work longer. And so the question there, when you come to that first one, is, are we going to raise retirement ages or not at some point? That becomes to me more of an interesting policy economic choice relative to taking the demographics as given when it comes to the first channel. Second channel, how are bequests going to change? The world seems to be more unequal. Maybe, I don't know, those things may revert. Actually, inequality has been falling a lot in the last few years, but who knows? To what extent do you think, though, that in a world more unequal, I want to, A, leave a bigger bequest to my children. My bequest, think about this as invest in their human capital, not just physical capital, so that they're the top 1%? Or do I say, the top 1% are going to take care of the other 99%, so I don't have to leave them anything? I think a lot of interesting papers, theory, empirics, and understanding how does inequality change my bequest money for savings will mean that in the demographics of older people with fewer young people that are more unequal between them could affect the incentive to save. And then third, when we come to the precautionary motive, the big risk, and one that, because again, I'm an economist, I worry about things too much, I'm too anxious, my wife tells me to relax, but I have trouble with it. I wonder, but also because I have a colleague, Charles Goodhart, who talks about this all the time, I'm going to get, in the same time that I'm going to live till I'm 85, 90, knock on wood, okay? I'm probably going to get dementia almost for sure. The incidence of dementia if you cross 80 is extremely high. I'm going to need 3 nurses to take care of me in 8-hour shifts. It's going to be very expensive to live. My precautionary motive says that I want to save a lot to be able to afford all those nurses. Unless, of course, the government provides them for me. The extent to which we're going to have public provision, the public policy we decide towards taking care of people with dementia, which are going to be a lot of us, by the way, and that's a good scenario, by the way, insofar as that means we live that long, unless, of course, we cure dementia by then, is not negligible. Given that, does that imply more or less savings? Again, very big question. So, taking the demographics as given, to get to this, I start with where you were exactly, and the C point, but then I try to at least motivate the younger researchers here, who will be able to answer it better, how this leads to very important economic questions, for which the answer is not clear, and I think a lot of great theory and empirics in economic research, looking at each of the savings motives and how, taking as given demographics, do we want to save more or less, is uncertain in really cool, researchable, to feed many theses that will get prizes given on the stage by Spanish economists or who work in Spain to try and figure that out. But I would encourage people to work on this topic. I think it's a phenomenal topic. Hopefully in the last 3 minutes, I left you with 9 questions that I think could be worth 20 dissertations. Thank you.